Okay, gang, I just want to put this market in perspective for you. When you have a market that's being driven by the tape, we call it news, and especially when you got every morning from October, if you go to your S&P, from December, right here, okay, so from December, this whole rally was driven by a narrative of China. Now, yes, we also had a lot of short covering because everybody who shorted the market, as I pointed out to you, okay, everybody who shorted it had to cover their position to take their profits. And that'll move up at least three quarters or half of the drop. So let's just bring it up to this point here. Because remember, it was at that point they had a lot of trouble breaking out because it was easy because all of these institutions sold short. So if I made $5,000 selling short, let's say from this point down here, I can't make any money until I buy those shares. That pushes the market back up. What really drove that was short covering. Then behind that came in more stock buybacks. And then behind that came in the narrative almost every time that this market pulled back, almost every time they were able to rally it back up with China. And you can see right here, okay, here's the first real pullback right here. Okay, then you had another big pullback here, another pullback here, and now we get another pullback here. So, but the trend is still in place. This is never broke. The S&P, the red line, has never broke through 80 and head towards 68. Remember, when you go to 80, break through 80, there's no guarantee how far the market's going to go down. We do know, because of experience, when it does reach 68 and breaks through that, 95% of the time it'll go down to between 5 and 13%, we'll say, down in here. All right, so my point is, every time it pulls back, as long as it pulls back, and you can see it right here, as long as the market pulls back higher than the last time. So she went up, she pulled back higher than this time here, see it? She pulled back again higher than this time right here. And then this time she's pulled back higher than this time right here. So you've got to get away from this nonsense every day of this craziness driven by the tape of China, okay? And so the thing to look at is look and see if, and not just the spiders, you also go and you look at IWM and you look at the banks, these three important ones, okay? When you look at those three, you want to make sure they haven't broke a 50-day moving average. And if they haven't broke the 50-day moving average, the S&P, see it right here, didn't break it. So here, so my trend is still intact. Every time it pulls back, it's higher than the previous time. It hasn't broke my critical 50-day moving average on the S&P. That's IWM. My XLF hasn't broken the 50-day or the 200-day, but used the 50. My S&P, I haven't broken the 50-day moving average, bounced off of it. So the key is, as long as you look at your market or your industry here, as long as you see that each time, okay, it's at a higher point when it pulls back, relax. Don't get caught in the whipsaw back and forth, because all that happens is when they start pulling back, if it can't break that 50-day moving average, those three, that's why we have these three for you to watch. These are the most important right here. And if it doesn't break the 50-day moving average, it's not going to break. The market's not going to collapse, okay? And remember, Trump has the plunger team to keep it up there. Now, so that's all I wanted to explain to you, because people are getting whipsawed. They're in, they're out. You don't know. When this happens, just relax. Let it play itself out. Just let it play itself out. The one lesson I always learned with flying, helicopter, when all of a sudden you got in trouble, you almost just let the thing go, and the cyclic, who can't pronounce it anymore, but so long since I flew, it almost like straightens it out itself. It's like when you climb a mountain. If you're hugging it so tight, you're never going to climb the mountain. It's the same thing with trading. Everybody starts panicking because they all see they start looking at the numbers here on the side instead of looking at, wait a minute, do I have higher lows? It's pulling back. Is it higher than the last time? Yes. Is my trend broken down through 80% heading towards 68? No. So there's nothing to get excited about. And you try not to trade it, because if you trade it, you get whipsawed back and forth that you can lose money. So that's what I wanted to explain, is when you get a market like this called painting the tape, which they're doing, just do what I said. Check if you got higher lows. And the three, here we are again, Spider, XLF, and IWM has not broken the key support, then you know darn well they're in there and they're going to try to support this darn thing, okay? But a lot of people get caught with this whipsaw back and forth. Sometimes you're better off just laying back in the weeds. Let it all settle out, okay? The market's going to do what it wants to do. But the key is the market's not going to collapse or give us a big correction unless three guys right here break through that 50-day moving average. One last thing. You always watch the 3-month Treasury and the 10-year Treasury. Right now, if you remember 4 weeks ago, I think it was, remember how the 3-month Treasury was higher than the 10-year Treasury? That was called an inverse. That is so important. It's telling you we're either in a recession, we don't know about it, but there's a high probability of another crash. Today, if you notice today, the 10-year Treasury and the 3-month Treasury, the 3-month Treasury is the same as the 10-year. If the 3-month Treasury now climbs higher than the 10-year, now you know that the institutions are going to start pulling their money out of this market. So these are key components. I just wanted to mention it to you, and this way you can just lay back, let things play out instead of trying to catch these big moves back and forth. It just drive you nuts. Okay? All right. See you on the charts.